Did you know that tax exemptions, tax deductions, and tax credits reduce the amount of money that the U.S. government collects by over $1.7 trillion a year? And while I'm heartbroken for the U.S. government, my job is to work for my clients. And so in today's video, I'm going to share with you 3 of the most powerful techniques that a lot of us can use to reduce our taxes and be part of that $1.7 trillion saved. And for many of us, this is going to be thousands of dollars, if not tens of thousands of dollars that you can save. They're super simple techniques. They're right down the middle of the fairway. None of this is controversial. And to put $1.7 trillion into perspective, that's more than the U.S. government spends on Social Security, which is $1.2 trillion. It's more than we spend on Medicare, which is $751 billion. And it's more than the U.S. government spends on our defense, our national defense, of $727 million. So these are real dollars that we can all save. So let's jump in. And first I want to talk about, there tends to be 3 groups of people that get most of these benefits. Real estate investors do very well, business owners do very well, and people that know the rules do really well. And today I'm going to share some of these rules with you in a very high level, simple way. So let's jump in. As a fee-only financial advisor for over 20 years, I'm well versed and I've seen many of these things, and I have clients that use these tools, but I'm not an accountant. So I'm going to start this off saying, this is not tax advice for you. I want to put these things on your radar screen so that you can look them up and you can work with an accountant or a fee-only financial planner to benefit from these as well. Okay, the first technique is going to sound complex, but it's really not. It's called tax loss harvesting. And that's essentially when you have a stock, a mutual fund, or an exchange traded fund, importantly that you've owned for over a year, that's gone down in value, right? And let's say you're planning on holding this position for 10 years. You've held it now 18 months and it's gone down in value. Well, one thing you can do is you can actually sell that position in order to recognize the loss, in order to harvest that loss, reduce your taxes, and then you can repurchase that position 31 days or more later. And oftentimes what you can do is you can find a similar position, particularly if it's an exchange traded fund. So you don't have to stay out of the market. There is a risk that stock begins to move, but the benefits of tax loss harvesting, for many of us, particularly if you can find another position that's similar to it, you can invest in that until your 31 days has passed, and then you can buy back into the position that you had originally. Conversely, for some people, it might make sense if you've had a stock that you've held over a year, an ETF, a mutual fund, to actually sell that stock. You actually sell the stock even though it's at a gain, and recognize that gain. And the reason for that is because the tax bracket for long-term capital gains, the 0% tax bracket is quite large. You can actually, as a married person, you can actually have a taxable income, married filing jointly, of over $94,000. $94,050 if you're single, it's half of that, $47,025. But it's even better than that. Your taxable income is what your adjusted gross income is, less your standard deduction. And so your standard deduction is almost $30,000. It's $29,200 for folks that are married, and it's half of that for folks that are single, $14,600. But the government also gives you, if you're over 65, an additional $1,550. So let's take somebody that's married and both the people are over 65. That standard deduction is $32,300. So again, it's that $94,050 for the married couple at the zero. You can sell a position with 0% tax bracket. So what you do is you actually sell that position, you recognize the gain, but you're harvesting that gain because you're at a 0% tax bracket. So that's tip number 1, is something called tax loss harvesting and tax gain harvesting. And you can look that up. You can call up an accountant and find out more about that. Okay, the next one doesn't have such a fancy name. I call it strategic bucket management. And what do I mean by bucket? When I think of buckets, I think about the accounts, the account types that we've saved money in. So is it a tax-deferred account like a regular IRA or a regular 401k? Is it a Roth version of that, which would be an account that you're never going to be taxed on anymore? Distributions, if you meet all the qualifications, the main one is over 59.5. Distributions from that Roth are going to be completely tax-free. And then on top of that, you just have your normal bank account down the street, a tax me as I go account, right? You can take $1,000 out of your bank account. The government doesn't tax you on that. So the strategic bucket management is thinking through which buckets you want your money in. And it makes sense to have some money in each bucket, again, because of those tax brackets that I shared with you, right? I shared the long-term capital gain tax brackets, but it's the same thing. It's the 10% and the 12% tax brackets, federal tax brackets, are pretty low tax brackets. And again, you can make a fair amount of money and be in the 10 to 12%. So let's say you've got money in a 401k or a regular IRA. If you can get that money out and only pay 10% or 12% federal tax on that, that's for a lot of people a pretty good situation. So thinking about this strategically, I think is really important. So we talked about the tax loss harvesting. We talked about the tax gain harvesting. The next one I want to talk about is what I call strategic charitable giving. And this relates to how our standard deduction now works. It used to be many of us were better off itemizing our taxes. But with the standard deduction now for married filing jointly, as I mentioned earlier, $29,200. And on top of that, if you're each person over 65 gets $1,550. For many, many people, we're just taking that standard deduction. So whether we make a charitable donation or not, it doesn't change that standard deduction, which is what we're taking. So the government's effectively not incentivizing us to make charitable donations. They're not reducing our taxes by a little bit when we make charitable donations. So the next one, what we do for strategic charitable planning and giving is we use a very simple tool. It's called a donor advised fund. I've done a video on a donor advised fund. You can see it up here. And it's essentially just like a normal custodian account. Firms like Vanguard, custodians like Vanguard, Schwab, Fidelity offer them. And essentially you can do multiple years worth of gifting. So let's say that, just for the sake of argument, you give away $5,000 a year to charities. Well, to take this to the extreme, let's say you do 20 years worth of giving in 1 year. So you take $100,000, you make that donation. Now, because it's that $100,000 level, now you're going to be better off itemizing that year, so you can take full advantage of that. But what a donor advised fund lets you do, again, this money is at Schwab or Fidelity, they allow you to get the tax deduction in the tax year that you made the contribution, but you can then decide later how much and to whom, which organizations this goes to. So then you could give away your $5,000 a year, and essentially the government is incentivizing you. The government is giving you a tax break. So look it up. It's called the Donor Advised Fund. Super simple, super powerful. You really do want to use that. Okay, and then the last one, this is a bonus for those that who have stuck here so long, is I alluded to it earlier, which is the tax bracket management. Looking at the lower federal income tax brackets. For instance, the 10% tax bracket kicks in for married people filing jointly. 10% tax bracket goes from $0 to $23,200. But again, this is after your standard deduction that you've got. So it's a really powerful tool. The 12% tax bracket goes all the way up to $94,300. And so you would add on that $29,200. So you want to manage the lower, we all wish that the tax bracket rate was 0, but that's not the way it works. But these lower tax brackets, 10 and 12%. And kind of related to this, a lot of people are thinking, how am I doing as a retiree? How do I compare to others? So this is the tax strategies, but I also want you to watch this strategy here, which talks about, not strategy, but video that talks about the average income for retirees in the United States. Thanks for watching this video, and I'll see you in there. Bye-bye.